I win because I'm good at losing. If you want to win, you need to learn to lose. It sounds contradictory, but it'll make sense in a minute. When it comes to setting a proper stop loss, I spent years spinning my tires and lost thousands of dollars before I learned two mistakes that were absolutely destroying my account. We've all seen the ads for some holy grail. All you need to do is give me your credit card, wait for two lines to cross, and you'll win 95% of the time, right? Look, I've never tried this indicator. Maybe it's a magic bullet. But what I can say is without a doubt, the best predictor of your long-term success is how you handle your trades when you're down money. Imagine you're driving down the road, minding your own business. You have a green light, but as you start to go through the intersection, out of the corner of your eye, you see a white car running the red light and you're a split second from crashing. It's in that moment, as your life flashes before your eyes, you realize you don't have your seatbelt on. That's what it's like to trade without a stop loss. You might take 100 trades without a stop loss. The market's calm, you get out, no problem. But sooner or later, out of nowhere, bam, the market slams into you. When the smoke clears, your account is wrecked. Every single time when I leave the house, even before I put the car in gear, my seatbelt's on. Not because I'm planning to crash, but if something unexpected happens, I want to be prepared. In the same way, I don't put on a trade thinking I'm going to lose, but it's a possibility. I need that protection in place before I demolish my account. I used to make the mistake of using a mental stop loss. I've heard conspiracies about brokers trading against their clients and hedge funds taking advantage of retail traders. I thought by setting an actual stop loss, it's almost as if I was advertising to the broker. If they push the price 1 cent below my stop loss, they can take my money. It's nonsense. In the long run, it's much more risky not using a stop loss. In the last video, I talked about mistakes in the General Electric trade, which should have only been a $300 loss turned into a $4,000 disaster. Now, how did that happen? My stop is here, and as price gets closer, I'm not ready to get out. I want to give it a little more room. Price keeps moving lower, but I hope things will turn around. Start imagining a double bottom, drawing all sorts of new trend lines to justify why I'm right. Stop was here, now it's here. All the while my account is bleeding more and more money. Have you ever heard the saying, plan the trade and then trade the plan? It sounds good in theory, but in practice, it's another story. When analyzing a trade beforehand, I'm calm, cool, collected. The setup looks good, trade shouldn't go below here, I'm risking 1 to make 3, all perfectly logical and rational. But planning the trade, that's the easy part. Trading the plan and sticking to it as price moves against me and I see that red number get bigger and bigger, that's where the rubber meets the road. My number one rule, written in stone, is stop losses are a one-way street. I can move it to break even, I can lock in profit, but you'll never see me again move the stop farther away to increase my risk. Have you ever been in a trade where price wicks down, hits your stop, takes you out, then turns right around and races back up? It's times like that when I used to regret having a stop until I learned to think about it in a completely new way. Here's a trade where that exact thing happened. The last 6.5 years, Cheesecake Factory has been on an absolute tear, up over 1,100%. I try not to jump on the highs, so I'm looking for a retracement. If it comes all the way back in no man's land, I'm not interested anymore. Price is retracing. It blew past the 50 and the 61.8 couldn't hold either. The 78.2 level has been providing support for over 2 months now. There were so many places to get into the trade. On the green candle here, 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 any of these would have been reasonable. a stop with a little buffer below the low from a month ago. First resistance would probably be this 38.2 blue line, which would be a 2-to-1. Back up to the most recent high would be 5-to-1, and a swing up to the 127 extension would be almost 7-to-1. So I put on the trade, and what happens? Not too long after, a large wick takes me out, takes my money, and then almost immediately races to the first target, and eventually hitting profits targets 2 and 3. Has that ever happened to you and you wish you'd only use a mental stop loss because you were right all along? It's a dangerous way of thinking, and I don't want you to get caught in that trap. In hindsight, it looks easy to wait out the wick, ride it back up, but in real time, it's much different. Now remember, this is a daily chart. Let's zoom in on just the 5-minute time frame for January 20th, 2016. The day starts here, pushes a little higher, immediately gets rejected, makes 3 lower highs, and hits the stop loss. My order's triggered, and I'm automatically taken out. But let's say you're the type of trader to have a mental stop loss because you want to see how price reacts before you decide. It's now been 30 minutes. Price peaked above that level a couple times, only for you to get your hopes up. Price is about 30 cents a share lower than where I got out. If I were in your shoes, instead of thinking clearly, I'd be kicking myself for not getting out while I had the chance. Besides, watching the price action over the last 30 minutes, there's nothing I see that would inspire confidence for me to want to keep going. Fast forward, stop loss got hit almost 2.5 hours ago, and it's getting close to the end of the trading session. Would you feel comfortable holding this below your mental stop loss and risking it gapping down in after hours trading? It's worth noting, there's nothing magical about this support. Price could easily retrace another 8% or even 27%. In this case, if you held the trade, you would have been right, but that's a dangerous game to play. I've seen flash crashes where it pops right back, and maybe I wish I didn't have a stop in place. But for every one time that's happened, there have been 100 times where the trade keeps moving lower, and I'm glad I stuck to the original plan and moved on. I love this quote by Jesse Livermore. The only thing to do when a person is wrong is to be right by ceasing to be wrong. Cut your losses quickly without hesitation. Don't waste time. It's an interesting slant. For years when I took a loss, I felt like I was admitting defeat. But in essence, what Jesse is saying is you can be right about being wrong. He goes on, losing money is the least of my troubles. A loss never troubles me after I take it. I forget about it overnight. But being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul. Here he even goes a step further, and being wrong to him doesn't mean losing money. Being wrong is defined as not taking the loss. Think back to the last time you stubbed your toe. In the moment, it hurt, but there wasn't any real damage. You forget about it the next day. That's what it's like to lose with a proper stop loss. Look, it's never pleasant for me losing 2% of my account on a trade. My ego takes a hit, but I live to fight another day. Take it from me, I've blown up multiple accounts. If you can't consistently handle small losses, sooner or later, I promise, you will suffer the mother of all losses. The market can be unforgiving. If you're not careful, one mistake can take you out. William O'Neill wrote, the whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount when you're wrong. Looked at from that perspective, getting stopped out is just part of the game. Let's say I have a win rate of 60%. On average, I'll be right 3 times in a row, only 22%. Bottom line, even if I do everything right, I'm going to be wrong a lot. It's just a question, will it be a manageable loss or will it empty my account? In this and in the last video, we spoke about two common trading mistakes, which are trading with only a mental stop loss and moving the stop loss farther away. Now, let's talk about the nuts and bolts of how to set a stop loss and how to move it. Rule number one, there must be specific rules for getting out of the trade. The best way I found is asking myself the question, where is my idea wrong? Let's say you want my opinion and you email me saying you're long Apple and you'll get out when XYZ happens. If it's well thought out, I should be able to look back and tell you exactly which candle should have exited your trade. So here's a bad example. You tell me you'll get out when the trend is over. It's a cliche thing to say, and in a minute you'll see it doesn't actually mean anything. From 2016 to 2018, Apple ripped up 137%. It's recently been pulling back and you think it's going to go back up. So you get in on the breakout around here. Apple has already been consolidating for almost 5 months. Is the trend over now? A lower low, down 20% from the highs. Do you want to get out now or just hold on? Dropped another 6.5%. Is the trend over now? Apple just made a new lower low. Not to mention, this wasn't a sudden drop. This downtrend has been going on for a year. Compare Apple to the NASDAQ for the same time period. Apple has lost 30%. The index is only down 3%. Would you still be comfortable in your Apple idea month after month when it's performing 10 times worse than the NASDAQ? If someone's an investor and wants to buy and hold for the next 5 or 10 years, just close their eyes and hope for the best, okay, fair enough. But as active traders, we need to be more clear about when we're wrong. In the heat of battle, when the price is going against you, when your emotions are overtaking your rational thought, it's at that exact second when you need to have a clear answer of what to do. So the strategy to get out when the trend is over is completely worthless because of how vague it is. So here's an excellent trade plan. Notice the difference. You tell me you trade Apple in the 1 hour time frame. You enter a trade when the 50 EMA crosses above the 200 EMA and the price is above the 50 EMA. Initial stop is at the intersection of the 50 and the 200, and you exit when either this is hit or when the 50 closes below the 200. I can tell you exactly where you entered and where you got out. Here we see the fast EMA is green and the slow is blue, set to 50, 200, and EMA. If we go to the very beginning of the chart in 2013 and start backtesting, you and I should enter and exit at exactly the same spots. Here's our first signal. Green line crossed above the blue, green candle is above the green line. We go long, set stop limit to the yellow cross, price comes down, we lose 1 R. Second trade, another loser, so now we're down 2 R. Third trade, almost hit our stop loss, keeps going for almost 19 R. Next trade is good for 2.6 R. Another huge winner, 13.7 R. Next trade profit, 7.5 R. Let's keep going until we have one more loss. Next trade didn't work out. These trades are a good example of what I was talking about in the last video. I cut the losers short, but let the winners run. I won less than 60%, but ended plus 39 R because of how much larger the wins were than the losses. You don't even have to be at your computer all day. Websites can send you text or an email to make sure you're exiting when you're supposed to. Link in the description below for the charting software. For this indicator, we're already long. All you have to do is right-click, add alert, set it to the short period crossing down the long period on bar close, and select the email or text option. There are 1,000 ways to enter a trade and 1,000 ways to exit. You can use moving averages or whatever indicator you want. Your definition of a trend may be different than mine. That's totally fine. However, one thing I can promise you is both you and me are experiencing the same emotions when a trade is losing money. It's natural for me to feel frustrated, to feel stubborn, and hope things will turn around. This is when I used to take those massive losses that I've disciplined myself now to avoid. So rule number one bypasses all of that. I have a contract with myself before I enter that says I must exit the trade when something specific happens. In the previous example, he entered because the 50 crossed above the 200. When the 50 closed below the 200, it was the opposite of why he got into the trade. And now he has a crystal clear signal that triggered him to exit. When you think about it, the ultimate goal of rule number one is to give yourself permission to be wrong. Recognize it and exit now instead of taking a bigger loss than you need to. One thing I can virtually promise you is if you don't understand rule number one and consistently apply it, you're almost certainly dooming yourself to being a losing trader. We're about to move on to rule number two, but if you need to rewind or bookmark this video to rewatch it later, do whatever you have to. If you put rule number one into practice, you'll look back on your progress in the not too distant future, and you'll be very, very impressed. Rule number one said we must have specific rules for exiting. Rule number two is your stop loss level must make sense on the chart. Let's talk for a minute about how price tends to move in general, and then we'll get into a specific trade. Here we have Euro USD on the weekly as far back as the chart goes. It's obviously uptrending with higher highs and higher lows, but if you look closer, price doesn't just move straight up. There's pullbacks all along the way. I want you to notice the difference between the lows marked with the red fractal arrows versus the highs of the up arrows. All along this uptrend, lows were never broken. This is definitely not true for the up arrows. We can keep moving the line from red to red and price never comes back in an uptrend. Now look at the difference with the green arrows. Price often breaks out and then comes back to retest this area before it continues moving higher. This pattern isn't 100% guaranteed. Sometimes there's no retracement to test the highs. Other times the retracement pulls back below the lows. But as a general rule of thumb, this pattern holds true for both day and swing trading, as well as forex, stocks, and cryptos. Keep the fractals in mind as we go through the next mistake when placing your stop loss. Here we're on the 4-hour chart for Goodyear Tire. There are a few reasons we think this might go higher. We have a bounce off the 50% retracement. On this candle, the 50 moving average just crossed over the 100 moving average. At the same time, we just crossed above the dotted line. This line was support about 7 months ago, turned into resistance, and now we're hoping price will break through. Now pay very close attention to the next part. It can save you a lot of money in the future. Here's a completely wrong way to set your stop loss, but how I used to think when I was a losing trader. I used to decide how much I wanted to risk, arbitrarily buy however many shares felt right, and then use those two numbers to calculate my stop. It might sound confusing, but I'll walk you through it now. Let's say my account is $1,500 and I want to risk 2%. That means if I'm wrong, I'll lose $30. Price is at 1808 and I'm feeling good, so I buy 80 shares. $30 spread over 80 shares equals a stop of 37 cents. I enter at 1808, which means I have to exit at 1771. A lot of numbers there, but you with me so far? All right, let's go back to the chart and see why this is a bad idea. The entry is at 1808 and stop loss is at 1771, just like we talked about. Looking for a profit target, these two highs line up, so we'll use that level. Getting almost 7 to 1, we're risking $30 to make 200. 6 candles later, it looks like it came right down to our stop and took us out, but hard to tell for sure. Maybe we got lucky, so let's keep going. Okay, there's no doubt now. We would have lost for sure. Letting the trade play out, we see we were right, but it doesn't matter. We lost $30 because our stop loss was in the wrong place. Let me show you what I mean. Now, if you recall, we said two things about uptrends. The lows are usually safe, the highs are often retested. So for example, we have an uptrend here. Let's say our stop loss was set around the recent low. Price goes up, comes back down, but we're safe and still in the trade. We move our stop loss up to the next higher low as price moves higher. It comes back down, but our stop is still in a good place. We move it up 2 more times and keep locking in more and more profit. Now, instead of using the recent low, we're going to use the recent high as our stop loss. Price goes up, retraces, retests the recent high, and hits our stop loss. Price is moving up, we get in on the breakout, price comes and takes us out again. Same thing happens again and again. We'd be losing a lot of money. So with that in mind, the recent high is here. And where is the original stop? It's way up here. We shouldn't be surprised if price comes in the region to retest the high. So if your stop is here, you're just begging to lose money. We just saw that a recent low is typically a good place to consider placing a stop, which would be here. Now we're getting somewhere. We know we don't need to have the stop much lower than the bottom of the box, but we definitely need to have it lower than the top. Obviously, a stop loss is one particular price, not a range. So now let's talk about other factors to consider that will help us be more accurate and lose less money. When choosing an optimal stop loss, I typically look at 4 things: the average true range indicator, minor support and resistance levels, where the various Fibonacci's are, and if there are any round numbers that might provide psychological support. More times than not, at least 2 of these will be pretty close together, and we can take the large range between the recent high and recent low and zoom in for the new stop loss. So let's go back to our good year trade. The first indicator we want on the chart is average true range. Search for ATR. There should be a number in the top left corner. If not, right-click Settings, Status line on the left, and check indicator values. So now we see the current candle has an ATR of 0.43. Since we're on the 4-hour chart, what the ATR tells us is that every 4 hours, we can expect price to move up or down 43 cents. Remember, our stop loss was only set at 37 cents. So it shouldn't surprise us that in a matter of a few candles, price would go down 43 cents and hit our stop loss. Top left are some rules of thumb when using ATR to set your stop loss. We want to have a buffer and use a multiple. If you trade on the 1 hour or smaller time frames, I would multiply ATR by 1.5 to 2. The 4 hour I found 2.5 to 3 works well, and for the daily, 3 to 5 should keep you in the longer term swings. In this case, ATR is 0.43, so our 4-hour multiplier is 2.5, which means we're risking $1.07 per share. Stop loss will be our entry price minus the risk. Entry on Goodyear was 1808 minus 107 gives a new stop loss of 1701. Going back to our box, now we have the first point of reference. The second tool I use is minor support and resistance. I scroll to the left and add 2 or 3 levels that stand out. Scrolling back to our box, we're starting to get a cluster, which will help narrow our focus. Price has a tendency to stop at one of the Fibonacci ratios. How a fib works is you click on the 2 extremes, where the trend started and where it ended. You can think of fib as the percentage price has retraced. So if price started at 0, went up to 100, the 382 means price went down 38.2%, which would match up here at 62. If price retraced to the 61.8, that means price went down 62% and would now be 38. Double clicking on the fib, I have these 6 levels. In practice, we're going to watch these key fib levels for price to stop retracing and continue the uptrend. The downtrend might stall around the 38.2 or the 50% and continue upwards. Price could crash to the 61.8 but hold at the 78.6. The retracement could turn into a downtrend and price could go through all the levels. It's not a magic bullet, but these levels can provide a useful guide. Scrolling down to our actual chart, we want two sets of fibs, one on the recent swing and another on the bigger picture. Go from low to high on the recent swing, zoom out on the bigger picture, and then again, low to high. Scrolling back to the box, we had this cluster from before. Now we have a second group that we might be able to use for our stop loss. The last factor to consider are round numbers. Price seems to be drawn to these obvious amounts. Say price has been hovering between $205 and $210. People's eyes are naturally going to lock on a $200 level, and that's where they'll put their limit order. I've gone through old charts and I found it's very easy for price to go from 205 to 200, but all of a sudden there's a new interest and price stops going down for the time being. If price is at $50.42, it's very easy for it to fall to $50, but much harder for it to break through and get to $49.50. I'd draw the line at whole numbers. Once you start getting into cents, maybe 50 cents is more obvious of a target than 60 cents, but 60 cents is the same as 70 in my opinion. The other thing to keep in mind is once price gets to these round numbers, we're anticipating more support than normal, and we want to put our stop loss just below, not right at these numbers. In terms of stop loss, $199.83 is much better than $200 even. Same with $49.88 instead of $50. Going back to the box for Goodyear, we have two round numbers, 17 and 16. So I would add two lines at 1693 and 1593. We ended up with two possible places to put the stop loss. Let's mark the two clusters, clean up the chart, and the last thing we have to do is eliminate any stops that give less than a 2-to-1 reward to risk. Our first stop gives a 2.38 to 1, so that's reasonable. Second stop is only 1.8 to 1, so it's eliminated. What would happen if we bought 80 shares and then moved the stop loss from where it was to $16.94, where it's less likely to get hit? Count was $1,500 before we were risking 2%, which is $30. A wider stop means we'll get stopped out less often, but when we do, we'll lose more money. Now we're risking $1.14 instead of only 37 cents per share, and our risk increased 3 times, going from 2% to 6%. If we want to keep 80 shares, we're between a rock and a hard place. If we only want to lose 2%, then the stop loss is forced to be in a terrible spot like we saw before. If we want the stop loss to make sense, it's going to come with 3 times more risk. The moral of the story in rule number 3 is determine stop loss before the share size. Here's a simple spreadsheet you can use to calculate share size. Link in description below. Input the updated numbers and the bottom 2 rows will update automatically. Count size is 1500, entry at 1808, exit at 1694. The final answer for 2% risk is 26 shares. And just to verify the math checks out, we want to risk a maximum of $30. 26 shares times $1.14 is $29.64. So far, we've talked about analyzing the chart to figure out where the stop should go, how big to enter, and then placing the stop loss at the same time you take the trade to avoid being caught up in the emotions of trading. Those are all well and good, but if you mess up the next point, you could still blow up your account. This is the Thinkorswim platform, which is commonly used to trade stocks. There are 8 different order types, with 4 of them having the word stop in it. In a future video, we'll talk about using the trailing stop to maximize profit, but for now, let's talk about the difference between the stop and stop limit orders. Pick the wrong one and you can be in a world of hurt. For context, think about when you want to get into a trade. You can either set a buy limit or a market buy. You think price is going to go up, but you're not willing to pay the current ask of $46.50. So you set a buy limit around $45. When it comes down, your order will be triggered. That sounds good, but what if price does this instead? You were right about the trade, but it does you no good because your order was never actually executed. Go back in time and say to yourself, I don't want to miss out on the trade. In that case, you would set a market buy. The good part is you're guaranteed to get filled and not miss out on the trend, but there's no free lunch and you're going to pay the higher price instead of $45. With that in mind, when you set a stop loss, it works in almost the same way. You can either use a stop, which is the market stop, or you can use a stop limit. You got into the trade, but price takes a nosedive. You set your stop loss to take you out at 45.08. But what actually happens is when price hits 45.08, your broker executes the order at the best available price. If the market is moving fast, you might get out at 45.08, but you might get slipped anywhere from a few cents to $1 or more. In Thinkorswim, the order option stop refers to a stop market. The benefit is you know that no matter what, you're out of the trade and you don't have to worry about it anymore. The downside is you might lose a little more than you were expecting. Now, look at the right side. If you were patient enough, price eventually came back and you would have exited the trade at 45.08, which is the exact price you were planning on. With a stop limit, your price is guaranteed. However, the risky part is price might continue dropping and you would continue holding those shares as it gets lower and lower with no end in sight. Let's take a look at what can happen on a real chart. Goodyear on the 30-minute time frame. Buy signal where the 100 crosses above the 200, and let's pretend we enter. Next 6 or 7 candles are down, but haven't got stopped out yet. My gosh, candle drops so much it doesn't even fit on the screen. This is really where the stop market versus stop limit comes into play. Original stop loss was somewhere around $1. Where would your order get filled? Sure, there's going to be some slippage. Maybe $1.25, maybe $1.50. Worst case scenario, maybe double your expected risk. Now imagine you use a stop limit instead and you watch the trade play out. If you did nothing, you would still be in the trade, down almost $12 a share. 12 times more than you were planning on risking. And not just for an hour or two, 300 days. Imagine kicking yourself for 10 months, wishing you had the sense to use a proper stop loss instead of wasting time and money and dealing with more stress and regret. Don't be penny wise and pound foolish. A stop market will usually get you out 5 cents worse than a stop limit, but it's a small price to pay for the insurance policy in case something really bad happens. I would never use a stop limit, and I don't recommend you use it either. Save yourself the pain of taking one of those massive losses. The point of a stop loss is to take you out of the trade when you're wrong. A stop market will do that for you, but a stop limit could leave you in limbo. Martin said it's okay to be wrong. It's unforgivable to stay wrong. Placing a proper stop loss will take practice. You don't want it to be too close where a normal wick takes you out, but you don't want to set it so far away where it's hard to get a good risk to reward ratio. So in general, our win rate is going to be somewhere around 50 to 60%. That means out of 10 trades, we're going to be wrong 4 or 5 times. It's going to happen a lot. Nothing to be upset or embarrassed about. The most important thing that winning professionals do better than amateurs is taking the small hit now before it turns into a large loss. Always keep in mind, ask yourself, where on the chart would my idea be wrong? Set a box with the fractals, narrow it down with support and resistance, Fibonacci and round numbers. Eliminate trades with less than 2-to-1 reward to risk ratio. Once you set your stop loss, use a maximum of 2% risk and have the spreadsheet calculate position size. And last but not least, a stop limit might not trigger, so always use a market stop. George Soros wrote, "It's not whether you're right or wrong that's important. It's how much money you make when you're right and how much you lose when you're wrong." Setting a proper stop loss will help you to not crash your account, but that's only half the battle. If you want your account to take off, you also need to know how to have a profit target to shoot for. And that's what the next video is about. Click the video here, and I'll see you on the other side. So with that said, let's get into the nuts and bolts. Throughout this video, we had our take profit set at 2 to 3 times the stop loss and just let it play out. It's a good, simple way to trade, but we can do better.